Ever wondered how companies safeguard their financial health against uncertainties? Well, that's where financial risk management comes into play. It's a strategy that helps companies identify, assess, and manage the financial risks they face. These risks could be anything from fluctuations in exchange rates, interest rates, or commodity prices to potential defaults on loans. Let's break that down a bit. There are various types of financial risks that businesses need to be aware of. Credit risk, for instance, refers to the potential for loss due to a borrower's failure to make payments on any type of debt. Market risk involves the possibility of financial loss due to adverse changes in market prices. Liquidity risk is the risk that a company may not be able to meet short-term financial demands. Lastly, operational risk refers to the risk arising from failures of processes, systems, people, or external events. Understanding these risks is the first step towards managing them effectively. Now that we've identified the types of financial risks, let's delve into the toolbox that risk managers use to mitigate these risks. First up in our toolbox is a strategy known as risk diversification. Picture yourself at a buffet. You wouldn't fill your plate with just one type of food, right? You'd select a variety of dishes to ensure a balanced meal. Similarly, risk diversification involves spreading investments across various assets to reduce the impact of any single asset's poor performance. It's like the old saying goes, don't put all your eggs in one basket. Next, we have financial derivatives, which are contracts that derive their value from an underlying asset. These include futures, options, and swaps. Let's break these down. A futures contract is like a reservation at your favorite restaurant. You agree today on a price for a meal that you'll eat in the future. In the financial world, you're agreeing on the price of an asset at a future date. Options, on the other hand, give you the right, but not the obligation, to buy or sell an asset at a predetermined price. Imagine you found the car of your dreams, but you're not quite ready to buy. The dealer offers you an option. For a small fee, you can reserve the car at today's price and decide later if you want to buy it. That's how options work. Lastly, we have swaps. A swap is a derivative where two parties exchange financial instruments. Think of it as bartering. You trade something you have for something you want. For instance, you might swap a high-interest loan for one with lower interest, thus reducing your financial risk. Lastly, risk hedging is another tool in the toolbox. This involves making an investment to reduce the risk of adverse price movements in an asset. It's like buying insurance for your investments. By using these tools strategically, risk managers can protect their companies from financial uncertainties. Tools are only as good as the technique employed to use them. What techniques do risk managers use to optimize these tools? Let's start by discussing risk measurement and evaluation. This technique involves quantifying potential hazards and their possible impact. Picture a pilot gauging the weather before a flight. They measure the risk of turbulence and evaluate its potential impact on the journey, allowing them to make informed decisions about the flight path. Next, we have stress testing. This is akin to a fire drill. It's about putting your financial systems through simulated scenarios to see how they would fare under extreme conditions. It's like a reality check for your risk management strategy, a way to test its robustness and identify any potential weak spots. Lastly, there's scenario analysis. This involves creating hypothetical future scenarios and seeing how they might affect your financial standing. Imagine if you're a farmer and you're considering how a particularly harsh winter might impact your crop yield. By doing this, you're effectively carrying out scenario analysis. In the world of financial risk management, these three techniques, when applied effectively, can help a company navigate the unpredictable seas of the financial market. They provide a roadmap, highlighting potential pitfalls and opportunities along the way. They're not foolproof, but they certainly stack the odds in your favor. These techniques allow risk managers to anticipate and prepare for financial uncertainties, ensuring the company's financial stability. In just a few minutes, we've navigated the complex world of financial risk management. We've explored the types of financial risks, from market to credit to operational. We've discovered the tools at our disposal, like derivatives and insurance, and we've learned how to optimize these tools using techniques such as diversification and hedging. These key points form the foundation of successful risk management. Remember, in the world of finance, the ability to manage risk effectively can be the difference between success and failure.